Hello students, I hope you're all doing well. Welcome to another video by QuickStudy, and this video covers books of original entry from topic 2, Introduction to Bookkeeping. And in this video we are going to learn about the purpose of books of original entry, why do we use them, and we'll learn about the following books of original entry in this video, like the purchases daybook, the sales daybook, the purchase returns daybook, and the sales returns daybook. Alright, so what are books of original entry really? So this is a type of journal where all the transactions are recorded for the first time before they are transferred to the general ledger. And when we are making original entries in the books of original entry, there are different kinds of transactions, right? Business will incur on a day-to-day basis. There are transactions related to revenues, purchases, cash, and etc. And all of these are recorded in different books of original entries. So as we have already talked in the previous videos that there are different types of business documents, and all the transactions will actually originate from a business document. So those are also known as the source documents. And the business documents include invoices, credit notes, checkbook stubs, paying-in slip, etc. And the book of original entries is basically a crucial step in accounting as it records all the transactions chronologically, and it serves as a source document for the general ledger too, which is used to prepare the financial statements of a business or business organization. All right, so what are the different types of books of original entry? So these are the different types of books of original entry where the transactions are recorded before they are transferred to the general ledger, right? So firstly, we have the sales daybook. A sales daybook is used to record the credit sales. This is basically sales where the payment is yet to be made. Then we have the purchases daybook, which is used to record all the purchases that has been purchased on credit. And then we have the sales returns daybook, which includes all the transactions that are related to the goods that are being returned by the customers. And then we have the purchase returns daybook, which records all the transactions which are related to returning goods that the business has bought from the supplier. And then we have the cash book, which is used to record all the transactions that has incurred in cash payments, the cash that has come into the business or the cash that has gone out of the business. And then we have the petty cash book, which records all the smaller cash transactions. Following that, we have the general journal, or the journal, which is used to record transactions that does not fit into all the other categories that we have just discussed. And these books of original entry are essential to make sure that your financial statements are accurate and that your records are reliable. And using this information, we'll be able to prepare the financial statements. All right, so what are ledgers? As we have just discussed, initially all the transactions are entered into the books of original entry. Eventually, they are transferred onto the ledgers using the double entry bookkeeping system. So this is when the information from the book of original entry is transferred to the ledgers. And this system requires that every transaction has a debit and a credit entry. So this is the double entry bookkeeping system, right? And what we do is basically post the transactions into these ledger accounts. And the process of transferring this information from the books of original entry to the ledgers is called posting. And this process will ensure that all the financial transactions are accurately recorded and that the accounting system is balanced. All right, so what are the different types of ledger accounts where we will post the transactions from the books of original entry? So there are receivables ledger, which is basically the trade receivables ledger. This ledger will record the customer's personal accounts who owes money to the business. Then we have the payables ledger, also known as the trade payables ledger, and this will record the personal accounts of the suppliers to whom the business owes money. And then we have the nominal ledger or the general ledger, which will contain all the remaining double entry accounts, which is basically the assets, the liabilities, the income, and the expenses. And as you can see here in this image, all right, so as you can see here, firstly, we have all the business transactions. And then what we're going to do with this is classify all these transactions because there are transactions which are of similar types. So we have to put the same types of transactions together. So you have transactions that are related to the books of original entry. Initially, we are going to record these transactions in the books of original entry, right? So firstly, you have the credit sales, then you have the credit purchases. You categorize all these transactions based on these categories. And then you have sales returns. And then you have sales returns, and you have purchase returns. Then you have all the cash receipts, basically all the cash that has come into the business, and the cash payments, all the cash that has gone out of the business. And then you have other types of transactions. So what are you going to do with that? So for the credit sales, all the transactions that are related to the credit sales, will enter those into the sales daybook, which is a book of original entry, right? Then for the credit transactions which are related to credit purchases, you will record all those transactions in the purchases daybook. Then you have the transactions which are related to the sales returns, which is basically the goods that have been returned by your customers to the business. So you have to enter those transactions in the sales returns daybook. Then you will have the purchase returns transactions, which is basically when you are returning goods to the supplier. You record those transactions in the purchase returns daybook. Then you have transactions related to the cash receipts and payments, which has to be entered into the cash book. And finally, you have other types of transactions which do not fit into any other criteria, and you'll enter all those transactions in the general journal. And after you have classified all these transactions and put it into the books of original entry where it's supposed to go, you have to post these transactions into the ledger accounts, right? Like we have just discussed. And in order to record these transactions in the ledger, we use what is called as the double entry account system, right? Which is also basically represented by a debit and a credit. And the different types of transactions include the trade receivables ledger, the trade payables ledger, and the nominal ledger. All right, so as you are posting the transactions from the books of original entry into the ledger accounts, we have talked about how you have to classify the transactions according to their categories, right? So when you're talking about the classification of transactions, you need to understand that the accounts where we are posting are usually divided into two main categories. The first one being the personal accounts, and these are accounts for individuals or businesses. These may be accounts such as accounts receivable or for account payables. And these accounts will actually represent the debts that are owed to the company or by the company. And then for the second main category, we have the impersonal accounts. And these are accounts for all other items. And they are further divided into two categories. We have real accounts. These are accounts which will represent the business's assets, such as buildings, machinery, equipment, inventory, and etc. And then in another category under the impersonal accounts is the nominal accounts. And these are accounts which represents the expenses and the incomes of the businesses. So these will include accounts such as the revenue accounts, the purchases accounts, or other expenses accounts like wages, electricity, and commissions. And what this does is basically the classification systems helps a business organize these transactions and understand the business's financial transactions much better and make the process a whole lot more efficient. All right, so as we just discussed, as you are done now with the classification of the accounts and the transactions, you'd have to start posting. So how do you post into the daybooks at first? So firstly, we have the business source documents, right? So we'll use those. For example, we have the purchase invoice. Purchase invoice is basically a document which is issued by a supplier to a business when goods or services are purchased on credit. And as we have already discussed, it will include information like the date of the invoice, the name and the details of the supplier, as well as the goods net cost. Net cost of the goods basically means the price of the goods after applicable taxes or discounts have been deducted. The purchase invoice will also include the total amount due as well, which is basically inclusive of all the taxes and other costs which are applicable. So purchase invoices are essential source documents for businesses, and they are used to record purchases in the purchases daybook and to calculate the total amount that is owed to suppliers. And this is what a purchase daybook will look like. So as you can see here, this is what a purchase daybook will usually look like. This column includes the date on which the transaction took place. This includes the details from whom the business has purchased goods on credit. And then you have the total column. The total column basically shows the total amount of goods that has been purchased from the suppliers. So as you can see here, these are the different suppliers from whom you've bought goods from, and these are basically the amounts. And then you have a total column, and this total column is basically later on posted to the trade payables control account. This is basically the total amount of money the business owes to their suppliers for a particular period of time. Alright, now as you have just seen how you can record credit purchase transactions onto the purchase daybook, we are going to take a look at how you post these credit purchases into the payables ledger. So as you already know, after you've purchased goods on credit, firstly you record these transactions into the purchases table, and later on you'd have to post this onto the trade payables ledger. And how we are going to do that is going to be shown here. So each invoice from the supplier from whom you've bought goods is posted to the corresponding supplier's account in the payables ledger. And this is what it looks like. Alright, so as you can see here, from the transactions that we have entered into the purchases table, we'd have to enter these transactions into the trade payables ledgers, right? So we had 4 different trade payables examples in the purchases table that we last saw, and from each of these people we have purchased goods worth particular amounts, and these amounts are listed here, right? So from Fuller and Sons we have purchased goods worth this much. This PB basically stands for the purchases book, and this is numbered as 38 to keep proper records, and this is shown as the date, right? And then you have this supplier from whom you may have also purchased goods on credit from, and their total amounts are shown here. You have A. Lewis account from whom you have purchased goods worth this much. Then you have J. Mita account from whom you have purchased goods worth this much. So basically, a total of all these numbers will tell you how much money your business owes to the suppliers right now, which is later on entered into the nominal ledger. So as you can see here, you have the nominal ledger. So here you're going to post the total of the credit purchases for that particular period of time. And here, as you can see, on the debit side of the purchases account, you have your credit purchases for the month from the purchases book 38, which we have seen previously. And this is the total amount that is owed by your business to your suppliers. Alright, now that you have seen how you can post the transactions from the day books to the ledger accounts, let us look at what are cash revenues and what are credit revenues. So first of all, cash revenue. Cash revenue is basically when a customer will purchase goods or services from a business and pays for the services immediately in cash. So in this case, you don't really have to enter these transactions into the sales day book or the receivables ledger. This is because the customer is not in debt to the business since they have already made these payments, and the sales day book will only record transactions where the customer still owes money to the business, or will only record transactions in the receivables ledger when the customer owes money to the business, right? Which is not the case during cash revenues. And the transactions is basically directly entered into the cash book, since when it's cash sales, the customer is paying up front, will enter the transactions into the cash book and record it as cash revenue. So the cash book will record all the cash receipts and payments in the business, and it will also include cash sales. And the credit side of the cash book is used to record all the cash outflows of the business, whereas the debit side of the cash book is used to record all the cash inflows into the business. And then we have the credit revenues. What are credit revenues? This is basically when the customer will purchase goods or services from a business and pay for them later. And many businesses actually rely heavily on credit sales, and some even entirely run on credit sales. And when a credit sale occurs, the supplier or the seller will actually send a revenue invoice to the buyer or the customer. And this invoice will include the details of the goods and services that have been sold, including the prices, quantities, so on and so forth. And while businesses will have unique invoice formats, they'll generally follow a standard accounting format. This is to make sure that they are easily understandable. And invoices are typically numbered and include the suppliers and the customers' names and addresses for proper filing. Alright, now let's take a look at revenue invoices. So what are revenue invoices? These are documents which are issued by the supplier to a buyer when the goods or services are being sold for on credit. And this supplier will usually send the top copy of the invoice to the buyer of the goods, while the seller will retain the other copies for internal use within the organization. And the accounting department will typically enter the revenue invoices into the sales table, since these are transactions which has occurred on credit. The customer hasn't paid for these goods yet, right? So the revenue invoice will usually include information such as the date of the invoice when the transaction took place, the customer's name and other details, including the goods net cost, which is basically the price of the goods deducting any taxes or discounts. The revenue invoice will also include a total amount due, which is inclusive of all the taxes and other relevant costs. Alright, so this is what a sales daybook will usually look like. As you can see, it has a date column here where the dates are written according to when the transaction took place. Then you have the details column, which basically lists your credit customers. So these are people who have purchased goods from you but are yet to make payments to the business, right? And then you have the total column, which basically shows the total amount of the goods and services that are purchased by customers from your business on credit. And this is basically the total amount that is owed by the customers to your business, which is basically later posted into the trade receivables control account, which we'll look into a bit more detail in later chapters. Alright, now as you have just seen how we will enter the credit sales transactions in the sales daybooks, you need to understand how you will later on categorize these transactions and post it into the receivables ledgers, right? So there are a few steps that are involved in the process. So you'd have to post your transactions from the sales table to the receivables ledgers, and in order to do that, you'd have to make sure that each invoice is posted to the corresponding customer's account in the receivables ledger, right? And as you can see here in this video, all right, so as you can see here, after you have posted the transactions initially into the sales table for the goods that the customers have purchased from you on credit, you'd have to post these onto the trade receivables ledger, right? So this is what the trade receivables ledger will look like. These are basically the customer's accounts. So you have a customer, Gramston Sports, has probably purchased goods from you worth this much, 480 pounds, which you can also find in the sales table that we have just seen. And here you have the folio column. SB stands for Sales Book 26, which is numbered to give you a reference from which daybook is this entry coming from. And then you have the details, which is basically revenue, so it's credit sales, and then you have the date, and this is posted onto the debit side of the trade receivables ledger. Then you have BY Sports account, and you can see similarly how the amounts are posted and the details are written here. Then you have Delft Products account, and then you have Zhang Sports account. So these are basically the different credit customers who have purchased goods from you and credit. So what you're going to do eventually is add all these numbers up and post it into the nominal ledger, which is basically a revenue account. All right, students, so as you can see here, this is the nominal ledger. Here you will post the total of the credit sale that you've made to your customer. So as you can see here again, and here you'll always write the closing date, since the total amount is only posted onto the nominal ledgers from the receivables ledger on the closing date. And here you have on the folio column, you have the reference as Sales Book 26. And here is the total amount of money that your customers owes to the business at that particular point of time. All right, now let's take a look at purchase returns, which is also known as return outwards and purchase credit notes. So purchase returns will occur when a business will buy goods for resale, but they would have to return these goods for whatever reason. For whatever reason, as reasons could be such as there are defects on the goods that have been purchased, or there are potential damages, or it may have been incorrect orders. The business may have mistakenly over-ordered or over-ordered actually. And so when a customer will return goods to a supplier, the supplier will issue a credit note. This is a document which is sent to the customer, and it indicates that the supplier will credit the customer's account for the value of the goods returned. In essence, a purchase return is basically the opposite of a purchase, and a credit note is equivalent to a refund for a purchase. So basically what the supplier will do is reduce the claim that the supplier has on the customers by sending them a credit note. All right, now let's take a look at how you're going to do the bookkeeping entries for purchase credit notes. And basically, you have a purchase returns daybook, right? And the credit notes which are issued by the supplier for return goods are listed in the purchase returns daybook. And this is also known as the return outwards daybook. And what we do when we're recording credit notes is basically they are entered into the purchase returns daybook. And this is very similar to the invoices that are entered into the purchases daybook. And this process will ensure that the financial records are accurate and reflect the return of goods and the reduction in the amount that are owed to suppliers. Alright students, so as you can see here, this is what our purchase returns daybook will look like. It is very similar to the purchases daybook, and like every other daybooks, you have the date column, then you have the details column, which will basically list the suppliers to whom you are returning the goods, right? And then you have a total column. And this is basically the total amount of goods that you are returning to your suppliers. And this total amount will later on be posted to the purchases or the trade payables account, which we'll take a look at later on in the chapters. And this amount will basically reduce the claim of the customer to the supplier. All right, now let's take a look at how you're going to post the entries for the purchase returns into the purchase and nominal ledgers, right? So you'd have to record the credit notes that are issued by the suppliers for the returned goods and transfer the information onto the appropriate accounts, right? So like we have already discussed, firstly, initially the entry goes into the purchase returns daybook, and then you will post to the corresponding supplier's account in the payables ledger, right? And this is how we are going to do that. All right, so after you have posted your purchase returns transactions into your purchase returns daybook, you would want to post these transactions onto your ledger accounts, right? So firstly, here you have your trade payables ledger account, like Fuller and Sons account. So this is one of the suppliers to whom you would want to return goods, right? So as you can see on the debit side of this ledger account, this DR is what we call debit and this CR is what we call credit. So on the debit side of the ledger account, as you can see, we have the date as Jan 15, then we have written here purchase returns, and here you have a folio 40, which is basically a reference for purchase returns, and this is the amount. So this is the amount of goods that you have returned to this supplier, Fuller and Sons. And as you can see, on the credit side of the ledger account, we also have a transaction which is listed as purchases. And this is a date where we can see this is a transaction that has taken place much before. And here, as you can see, this is from purchase book 38. So here, as you can see, the amount is written as this. So you have purchased goods worth 172.80 pounds from this supplier, and then as you have returned goods, you have recorded that amount onto the debit side of the ledger account, which will reduce your claim to this supplier. And similarly, you can see the transactions on this A. Lewis account as well. On 2016, you purchased goods from A. Lewis, which is in reference to purchases book 38. This is the total amount of goods that you may have purchased from A. Lewis. And then on the debit side of A. Lewis account, you have on Jan 17, you have returned goods in reference to purchase returns 40. This is the amount of goods that you have returned. So this will basically reduce your claim to A. Lewis. And then after you have done recording these transactions into the trade payables ledgers account, you have to enter these transactions onto your nominal ledger, which is basically your purchase returns account. So this is basically a total of all the purchase returns that you have made so far. So this is also a total of the amount that will reduce your claim to the suppliers. As you can see here, this is the date as Jan 31, 2017. Total is coming from the purchase returns daybook in reference to purchase returns 40. And this is the total amount of goods that needs to be returned. And if you add up these two numbers, this is basically, just hold on a moment. And if you were to add up these two numbers, 38.40 pounds and 120 pounds, you will get this total amount. All right, now as we have just talked about how you record the transactions into the purchase returns daybook when you return goods to your supplier and then eventually onto the trade payables ledger and the nominal ledger. Now we're going to look at how you record transactions related to sales returns, which is also known as return inwards and credit notes. So basically, sales returns will occur when a customer returns goods to the supplier. And when this happens, the suppliers must rectify the situation by issuing a credit note. And there are various reasons why you would want to return goods, right? So first of all, they may be unsuitable for use. So the goods supplied may be faulty, damaged, and unsuitable, or part of an incomplete consignment, and the supplier must make an allowance or reduce the price or reduce the claim that they have on the customer. So the credit note is basically when the supplier will issue a credit note to the customer, and it indicates the amount of the money on which they have agreed upon to reduce. And this is basically a customer's debt. So the customer is in debt to the supplier for the value of the goods that have been delivered, and the credit note will actually reduce this debt. All right, now we'll take a look at how you will basically record these transactions for sales returns, right? So the bookkeeping entries for revenue credit notes are like this. So credit notes, as we have already talked about, are source documents that will record the sales revenue adjustments when the customers will return goods, right? And so you will enter these transactions onto the sales daybook first, as it's the books of original entry, and initially this is where the transactions are first posted. And this is what our sales returns daybook will look like. All right, students, as you can see here, this is what the sales returns daybook will look like, which is very similar to the sales daybook. And this is where we'll do the bookkeeping entries for revenue credit notes. So as you can see, like every other daybook, there's a date column, there's a details column where you will list the names of the customers who have returned goods to you, right? And then you have a total column. And this is the total amount of goods that have been returned to you by the customers after you have sold to them. And then after this, what you're going to do is post these credit notes to the revenue and nominal ledgers. All right, now we'll take a look at how you're going to post the credit notes to the revenue and the nominal ledgers. So as we already know, initially the transactions are entered onto the sales returns daybook, which is the books of original entry, and then eventually we're going to transfer or record these transactions onto the receivables ledger, right? So you have to make sure that each credit note is then posted to the corresponding customer's account in the receivables ledger, and this is what it would look like. All right, students, so this is how you're going to post the entries from the daybooks onto the receivables ledger. So Gramson Sports may have been one of your customers. Zhang Sports may have been another one of your customers. So as we can see, there's a debit side to this account, ledger account, there's a credit side as well. And on the debit side of the account, we have a transaction from May 4th, 2017, which shows that you had sold goods worth £480 to Gramson Sports. But on 2017, June 11th, we can see that there was a revenue returns, which means that Gramson Sports has returned us goods worth this much. And what that would mean is basically we are going to reduce our claim on this particular customer, Gramson Sports, since they have returned us goods worth this much. And then similarly on Zhang Sports account as well, on the debit side of the ledger account, you can see that we had sold goods to them on May 29th, which was worth £213.60, and then later on in June 24th, there is an entry for revenue returns on the credit side, which means that Zhang Sports may have also returned to us some goods worth £67.20. It means that we are going to reduce our claim on this particular customer, Zhang Sports, by £67.20. Right, students, as you can see here, this is the nominal ledger. Here we are going to post the total of the revenue returns, or the total amount in which the customer has returned us the goods, which is basically recorded at the closing date, again, as we have talked before, since we post this at the end of the financial records. So you have the total sales returns book on the detail, and then you have the folio as sales returns 11, and here is the total amount as 153.6 posted on the debit side of the revenue returns account. Alright students, now that we have looked at how you can post your entries into the revenue returns account, let's talk a bit about cash discounts. So what are cash discounts? So businesses will offer discounts to encourage their customers to pay their invoices as soon as possible. Customers who pay the full invoice within a specific period may actually receive a discount on the total amount that they owe, since they are making earlier payments. So this can actually help the business in many ways. One of the main ways is that it helps with the business's cash flows. So since the customers are paying back early, it improves business's cash flow. At the same time, the cash discount is basically a reduced amount that a customer owes if they pay within a specific period of time. And the discount can be applied regardless of whether the payment is being made by cash, by check, or by direct bank transfer. And the discount is usually a percentage of the amount that the customer owes to the business. And the revenue documents, the percentage that are being allowed and the payment period are all clearly stated on all the revenue documents that are issued by the seller. And the typical period for the discount terms is usually 1 month from the original transaction date. And by offering cash discounts, a business can incentivize their customers to pay earlier, which improves the business's cash flow and also reduces the chances of bad debts. Now, cash discounts can be of different types. Primarily, cash discounts are the reductions in the amount that the customer will pay to the supplier. And the two main types of cash discounts are discounts allowed. This is when a business offers cash discounts to customers for early payments. And the second type of cash discount is basically discounts received. This is when a business receives discount from suppliers for early payment of their accounts. And both the cash discounts can be recorded in the accounting system to reflect the reduced amount owed or received. All right, students, as you can see here, this is an example of how a business applies cash discount. So as you can see here, C-Chan owes us $100, and on September 2nd, 2017, he pays by cash within the time limit, and the business allows him a 5% cash discount. So therefore, Chan will pay $100 less $5 cash discount, which is $95 in full settlement of his account. And what that means is that the effect this will have on the accounts is basically the cash will be increased by $95. The asset, which is basically an asset of trade receivables, which will be decreased by $95. And the action we will take in regards to this is basically debit the cash account, which is enter the $95 in the debit columns of the cash book, and credit C-Chan's account by $95. And for the discount part, the asset of trade receivables will be decreased by $5. And after the cash has been paid, there remains a balance of $5, which is the discount amount, right? And as the account has been paid, this asset must now be cancelled. And the expenses of discounts allowed will also be increased by $5. So discounts allowed are essentially expenses for a business. Now the journal entry this will have is basically we'll credit C-Chan's account by $5 and debit discounts allowed account by $5. And this means that C-Chan's debt of $100 is shown as fully settled, and the accounts also show exactly how the settlement took. Alright students, this is another example where a business owed R. Abbas $400. They pay him by check on 3rd September 2017 within the specified 30 days. So the business claimed 2.5% cash discount, and the amount paid to R. Abbas is $400 less $10 in cash discounts, which is $390 in full settlement of the account. And the effect this has had on the check is that the asset of bank is reduced by $390 as you have made payment to your supplier. So the liability of trade payables is reduced by $390 as well. And the action that we're going to take is credit the bank account, which is basically entering the $390 on the credit side of a bank column, and debit our Abbas's account, who is our supplier's account, with $390. And for the discount part, the liability of trade payables is reduced by $10. And after the check is paid, basically the balance of $10 remains. As the account has been paid, that liability must now be cancelled. And for the revenue of discounts received, it is increased by $10. And the action for discounts we're going to take is debit our Abbas's account, which is a supplier's account, by $10 and credit the discounts received account by $10. Alright students, so as you can see here, we are now going to look at how we are going to record the transactions for discounts onto our cash book. So as you can see, C-Chan is posted on the debit side of the cash book. And as you can see here, the cash that you have received from C-Chan, who is our credit customer, we're supposed to receive $100 from C-Chan, right? But we have received $95. And the remaining $5 is the discount that we have allowed to C-Chan, our credit customer. And this $5 in return is posted on the discounts allowed account on the debit side. See, this is the $5, right? And similarly, on the credit side of the cash book, since our boss was our supplier, we have made payments worth $390, whereas we're supposed to pay him $400, and the remaining $10 was received as a discount for our business, which is posted on the credit side of the discount received account. As you can see here, this is the credit side of the discount received account, and we've received discount worth $10. Alright students, now we are going to take a look at how the discounts are entered into the nominal ledger. So firstly, we have the straight receivables ledger on the C-Chan account. As you can see, there was a balance of $100 which our credit customer had owed to us in the beginning of the month, and during the month he has made cash payments to us worth $95, and the $5 was a discount that we've allowed to him. So C-Chan's account has been closed for the month and the balances have been settled. Similarly, on the trade payables ledger, this is our boss's account, we have on the debit side of bank, since we have made payment to him worth $390, and we have also debited the discounts received amount on his account, which reduces his claim on our business by $10. And on the credit side, you have a balance of $400, which means it has been settled for. There is no remaining balance. Alright students, so as you have just seen, this is how discounts allowed and discount received are recorded in the ledger accounts and the nominal ledgers. And now we are going to talk about how these discount amounts are posted onto the cash book. So as you have discount allowed accounts and discount received account, these are in the nominal ledger along with other revenue and expense accounts. So there are extra columns in the cash book to record your discounts received and discounts allowed. So for the discount received column, we would enter them on the credit side of the cash book, and for the discount allowed column, it will be on the debit side of the cash book. Alright students, so this is what you can see. This is the cash book, and on the debit side of the cash book, we have a discount column, which is basically the discount allowed column. We have $5 here. This is the discount we have allowed to C-Chan. And on the credit side of the cash book, we have the discount received column, and this is the $10 worth of discount that we have received from our supplier, our boss. This is how the discount allowed and the discount received columns are placed on the cash book. Alright students, with that we have come towards the very end of this video, and to give you a short recap of what we have covered so far, we have talked about the purpose of books of original entry, and we have talked about the following books of original entry in this video. We've talked about how to prepare purchases daybook, sales daybook, purchase returns daybook, and sales returns daybook. We've also talked about discounts such as discounts allowed and discount received, and we've also talked about how these are adjusted for in the cash book. And students, with that, I'd like to thank you for watching this video, and if you've liked this video, do subscribe to our channel as we post regularly on different topics and subjects that can help you ace your GCSEs. And of course, if you'd like to know more about us or our online tutoring services, do visit our website at www.quickstudy.uk. Thank you.